everybody, Payments Professor here, and it's the Summer of Risk. Today we're going to be focusing on liquidity risk. Liquidity risk. What is really liquidity risk? Well, you can look, it's like my liquidity here, it just started to filter away. I started off strong, but then it kind of dies down at the end because, well, it got liquid involved. Okay, that's not really it. It is wet board, and that's really what caused it to do it. I really meant to make that happen, though, just saying. All right, liquidity risk, though. I made a video once about me going under the sea, and Dora was flying around with liquidity risk. I've got Dory in the background here to keep on swimming when it comes to working with risk. In fact, we're going to be talking about liquidity risk. Now, exactly what is liquidity risk? It is the risk that current and potential risk really to earnings or capital arising from a financial institution's inability to be able to meet their obligations when they come due without incurring some type of unacceptable loss. So it's the L in our scroll, liquidity risk. Now, what are some of the things that are really red flags of liquidity risk? Now, there's a lot of different things. A lot of it is how you're looking at it. It can be rising delinquencies. It can be rapid deposit growth. It can be rapid earnings growth. Properly managing liquidity risk. What's that mean? It means really understanding all of your sources and uses of liquidity. It means setting specific requirements for liquidity levels. It means being able to look at things like having controls over your daylight overdraft. It means having controls for dollar limits and activity thresholds. Those are really the main things when it comes to liquidity risks that we're looking at. But when it comes to electronic payments, let's do like Dory and just keep on swimming. Okay, liquidity risk is really simple. It comes down to this. It's having your investments in a lot of different things, and it comes time to be able to collect on those investments. So let's say make them into cash. And I want to go and make them into cash, but I either can't because there's forces that are blocking me. Maybe, say the bank's not open, so I can't go get my cash. Yes, I know you could go get it from an ATM, but we're just saying hypothetical here. Or it could be a case of I made the investment and I go get the money back and it's not worth as much as it was. For a lot of you with Bitcoin, that has happened. There was a point where Bitcoin was soaring, and depending on when you bought, then it crashed. And, well, it didn't really crash, but it's not worth as much as it was. That really comes down to what liquidity risk is. It's when you go to collect whatever your investments are or wherever your money is, that you're not going to be able to get the money back. So that's liquidity risk. It's like being underwater, and it's something that you got to be able to consider when it comes to working with the different types of payments that are out there. What's really interesting is when it comes to faster payments or real-time payments, liquidity risk is one of the things that faster payments protects against the most. And why is that? Because settlement takes place immediately. In fact, the process of settlement taking place, and I had a video earlier this year on clearing and settlement and what's the difference between them. Settlement is really when the financial institutions exchange money and it's final. We know we're done with the payment. Are there recourses? Absolutely, but we're just saying at that point in time it's done. And at that point in time, we know that we're going to be able to get our money. We know that we've actually got our money because settlement's taken place. And that's what helps protect against liquidity risk is when settlement takes place. Because until final settlement takes place, that is where we could have a loss actually be suffered. In ACH, we could see it where before settlement takes place, if you didn't pre-fund, like we talked about in our credit risk video, then you could have a business that says maybe files for bankruptcy, but you've already sent out all their payments. And when settlement takes place, it'll take place against the financial institution account. They won't have the funds. Oh no, they're going to lose their money. Well, when we have settlement take place right away, that helps protect us against liquidity risk, right? That's how we're helping to guard against our payments in the summer of risk. If you got any questions, got any comments, please put them down below. Let me know, and I'd be glad to get some videos out there for you.